every single time, the unemployment rate, I don't have the data here for rate. Every time the unemployment rate goes up over 27% off a bottom, or it could even be less than that,
Mm-hmm.
27%. Recession. Look at recession. And these green overlays, they're um the declared ones, right? But look at the
Mm-hmm.
unemployment rate here. Goes up 27% off bottom, recession. Recession. Look at that. Recession. Look at
Yep.
that. Recession. 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 100% success rate. Recession. Look how much we've moved now off a bottom, 27%. And every time it's moved up 27 or 25%, it never fails to keep going up even more. Here it doubled. Here it doubled.
Interesting.
You see the recurring theme? It doubles here.
Mm-hmm.
It doesn't stop there. It doubles or triples. Here it quadrupled. So when I see that, I'm thinking we're very close to being in a recession. It's like, and the yield curve.
If not the fact that we already are in recession.
We could be. And silver dumping and gold dumping, it's signs that maybe we're in it, you know.
You're watching Capital Cosm. Today's guest is Patrick Karim. Patrick, thank you so much for coming back on the show.
Thank you, sir. Always fun to catch up, talk markets, and whatever we like.
Yeah, let's just dive right in. What is occupying your headspace right now, Patrick? What is front and center for you as it relates to the markets and the economy?
Well,
And feel free to pull up any charts if you want to.
yes. So I'll 100%, guys. I'll pull up some charts. We had a chance. Maybe this is a subject that's worth covering. There is the concept of capital rotation, and we have a name to it, like it's capital rotation process, and that's all going to be sealed off with a capital rotation event. And essentially, what that is, and I'll show you a chart, guys. It's these macro events where the SPX breaks down versus gold, and when that happens, it's just whatever used to work good most of the time will work now good much less of the time. So the growth stocks, all that, they're going to have, they're going to take a back burner. Money's going to start rotating out of growth and into whatever materials, energy, gold and the likes. So, but what's very, you know what? Well, I'm going to show the charts right now. So we don't, I know the visuals, guys, when we start talking technical, once you have a visual, it's much easier to see. So what I'm going to pop up, guys, it's actually going to be the gold chart. XAU USD divided by SPX. So this is a ratio chart, guys. A ratio chart, what it tells you, XAU USD slash, trying to make sure I get the big, okay, there we go.
Right.
A ratio chart, guys, it just tells you which of the two assets are outperforming. And any chart is a ratio chart when you think about it, because everything's denominated in a currency, right? So let's say you have SPX. Well, it's a ratio chart, right? It's one share of SPX divided by the
dollar.
as the dollar. So it's a ratio chart. It's telling you which is outperforming, right? And we assume because the currency is more stable in its universe that if there's appreciation in the asset, well, it's the asset that's gaining value, but it could be sometimes a combination of the asset going up, but also the underlying fiat is going the opposite direction. So there's that little nuance to be made. So here, guys, is the gold versus SPX, and I'm gonna remove all indicators, clean it up. It's since 1902. I'm gonna add recessions on top. So you'll see these recessions. Yeah, there were some before this indicator. It only starts in 69, and you'll notice a theme here. So when gold breaks out, what is that? A green line. Goodness gracious. Let's put that black. When SPX or gold starts breaking out versus, there's other lines here, versus SPX, something's happening. There's often a recession. The yield curve will be uninverting. Unemployment rate will be shooting upwards. There's something happening where the money flow, the passive money flow that's going in the SPX, because maybe unemployment rate, people can't contribute to the IRAs anymore as much. All that money now is now going to SPX. Once that rolls over, this becomes a bull era. I could overlay here the silver chart. I could overlay here the oil chart. I could overlay the uranium chart, the copper chart. They track these. I'm going to overlay them for you guys. New price scale. Here's a silver chart, logarithmic. So check it out. Here, the black is gold versus SPX, but look how silver tracks these capital flows, right? It tracks that. To a large extent, when gold is able to outperform SPX, no matter where, even if SPX going up or down, doesn't matter, they track those capital flows. So now we have silver here going bonkers, but the gold versus SPX has not broken out yet. Here it did back in, look at this, all the way back here. Guess what happened here in the 2000s? Look at that, another recession. These recessions here, they happen on these turns here, on these huge turns. There's a recession coming. I know people now, they see the market going bonkers and they say it's cool, there's no recessions, but there is one, and it will most likely happen. You're even starting to lose this downwards momentum here. It's really starting to, I'm going to zoom in here. We came very, very close. I'm going to put the candle chart, show you the wicks. This is how close we got, guys, to gold breaking out versus SPX. But there's one caveat to this. You notice the recessions, right? The recessions were there on the turns, right? Recession here, recession here. So what happens on these turns, the initial recession where the CRE event is confirmed, the SPX goes down because it's the recession fears. We know how the SPX tanked here in the 2000s. It did the same thing in the late 60s. And there's a high likelihood that when we have this recession here, the SPX will also tank. But gold also will not go up when this breaks out. So this is I can't say it won't, but previously when this ratio broke out to the upside, it's because the SPX was tanking, entering a bear market like severely, and gold was also going down, but not as fast. So what happens if you have two instruments, both going down, but one not as fast? Well, this will.
Can we see gold juxtaposed on this graph as well?
Yes, let's do it. And I'll even put a new price scale right there. Here's my gold. And I'll put gold on the log scale, and I'll put gold also on the candle chart. So check it out. Here is, well, okay, gold here, it was up. It's hard to see there because of the, it was pegged in this area, but gold did go down. It was all these little, I'll have to do it like this, guys, for you guys. On this one, where's my gold one? Here, candles. Put, where is it? Subline here. See, gold went down in the 70s before going back up on this turn while the ratio was starting to go up. And then when it broke out, it kept going up. In the 2000s, where's my 2000 line? Here. Zoom in for you guys. Gold went down initially and then went up as that thing starting breaking out. And here we are today, gold.
Oh, there's another one. In 08, it went down while the ratio ticked up.
Yes, it did it. The 08, these mid-cycle recessions, they are not CRE events, but they're like continuation events. So you'll have one of these huge recessions during a bull era. So after you have the initial CRE where it's the first capital flow event after a huge bull market for the US equities, then you'll have a halfway one where you'll have it again. You had the same thing in the 70s. Here you had the instigator, huge run up, and then after that you had the you had the second one, the halfway through one.
I see.
So this ratio, once it breaks out, either gold stays flat or gold dumps a little bit. But this will most likely break out because the US equities are starting to roll over, right? I don't know like how deep this is going to go. I put a scenario out on Twitter a little while back there that this was back, where's my date here? Oh, here, November 5th. And look, gold was super stretched from its moving average. Like people were super bullish. I put a tweet out. I use a word that gold is probably peaking right now. Maybe because I'm French, people peak. No, it's like the associated peak, like something really important. What I meant to say is like some type of, top, bull market top. I don't know what you want to call that there. For me, it's a peak, right? It's a peak of this run, but it was more like an intermediate topping pattern because look how stretched we were from the moving
Mm-hmm.
average. And that's when you have peak FOMO and people are, you know, gold could do no wrong. So that was the first clue right there. It was we're stretched from the moving average. Gold's had a great measure move run here. It's like it's reached its target. So the next thing to expect is some type of correction consolidation. How long, how big? It's hard to, you don't know. You just have to wait until see it play out. But would be very healthy is just let gold, let that 3 year moving average just catch up.
It
So
looks like we're due for a 36% correction, right? From the moving average.
well, right,
If you look at the
yes,
distance from moving average chart down below, it says we're
distance,
36% away from the moving average.
yes, but the moving average will keep going up, right? So the moving average right now is at 2000,
Mm-hmm.
2030, but every month, as long as you have samples above it, next month is going to be what, 2050, 2080, they're going to catch up. And that's why I drew this projected possible roadmap, right? It doesn't have to go that deep, but
Right.
the 3 year, the 36-month moving average could get right here, support us around,
Yeah. So if you look at 2020, we were at that same distance from moving average that we are today,
same.
right? And then we corrected all the way down from 2000, a little over 2000 down to what is it, 16 some odd
Yes.
change. So that was
Yes.
about a 20% correction, even though you saw a 36% correction from the distance from moving average.
That's right. And now this is like it's just telling you that there's a correction. So this is a beautiful uptrend, guys. Make no mistake about it. Gold is in a bull market. It's an uptrend. Higher highs. This is just going to create a higher low. It's like it's not like a peak where it's game over, right? But this sets up the opportunity for that gold to SPX ratio to break upwards. So if gold could start correcting, but they have no sign of doing that right now, right? Markets right now, they're in blow off top mode. It's like I could show you NVIDIA there if you want to do some more
Sure.
markets. Check it out, NVIDIA. I'll put it on here. Look how NVIDIA is stretched from the moving average. Look at that thing. Goodness. It's the same thing as
Oh
gold,
my
how
God.
it's historically stretched. So it doesn't mean there's two ways this could correct. Sometimes you're stretched and this could reset, but the price could still go up. It's just that it's not going up as fast as it used to. So the moving average catches up, right? That's kind of what happened here. Check it
Yep.
out here where I put the line. See the price kept going up for NVIDIA. So even as this was resetting, the price can still go up, but it's still not going up as fast. So you're vulnerable. Once you start slowing down, you're vulnerable for stalling. And once you're stalled, you're vulnerable for a rug pull, right? And that's what happened here. And we had a huge rug pull, 68% drop. So now NVIDIA, this is the way to do it objectively, guys. As long as it's above the 12-month moving average, is that blue line here, it's fine. As long as it's above this rising trend line, it's fine. You don't have to go panic mode. You don't short possible tops, guys. You don't do that. It's a nut trend. But what you have to realize is the low risk entry are down here, right? They're down here, not up here. Here you're at risk, right? The low risk entries are here. They're here. They're here. They're low and starting to trend upwards. So the risk, if gold could stay flat or correct, and Nvidia, I don't know, that's a huge component of the SPX and Nasdaq falters. And I think even the tech stocks today, I don't know what, like, yeah, they're not doing super duper, but they're still an uptrend,
But
guys.
Bitcoin is.
Yes, Bitcoin's going on fire. We could even I'll cover Bitcoin right
Mm.
after that. But right now, the SPX is king. It's like the Dow Jones already started faltering versus gold. The Russell started faltering versus gold. The TSX, but those are like babies. The SPX is like the top dog. So there's weakness here. There is weakness, and as soon as you lose that momentum, rising trend line here more severely, you're just entering a correction. How deep it goes? Well, for gold to break out on that other chart, this needs to go down and go down a lot. It cannot just be a small correction. It has to correct here, but then after that, it has to go. We need a bear market here for that CRE event to really materialize. You need a recession. You need unemployment rate to keep going up. But it is the unemployment rate going up. Did you see my chart on the unemployment rate?
No, go ahead and show it.
I'll show it to you. Check it out. This is all evidence, guys. This sometimes you look at one chart and the price going up and you can't see clearly anymore. Oh, it's a bull run. We're good for another 10 years and there's nothing to worry about. Hold on. It's more nuanced than that, guys. It's weight of evidence. I'm going to go to my highlights here. Did you know about Twitter or X there? You have highlights. I pinned some of my more important posts here. So
Interesting.
easy to reference. When I want to send somebody to something that I know is like it answers a question, that a recurring question, I just highlight them and I could find my important posts here.
I probably need to start using that.
It's super useful. Instead of searching and not finding the important stuff, and you could unpin and repin, and it will re-put it at the top of your highlights. Here's my civilian unemployment rate for the States. Check this out. I don't have the recessions highlighted. I could, but they're pretty much, I'll do it for you guys, if you don't mind. U.S. unemployment rate, U.S. Rate, unemployment, no. All right, there you go, guys. Let's just do it this way. Remove indicators. I'll add the indicator recession. Check this out, guys. Reset chart. Okay, check it out. Every single time, the unemployment rate, I don't have the data here for rate. Every time the unemployment rate goes up over 27% off a bottom, or it could even be less than that. 27%. Recession. Look at recession. They could back, and I don't know if ever you saw my tweet where I showed the official of recessions, like by the Labor Bureau of the United States versus when they declared it. So let's say we're in a recession, but it's most of the time they're always 1 year late to declare the start of it, of a recession, and
Yes.
most of the time they're 1 year late to declare the end of it. But look at this. Look
Yeah,
at
and usually by the time they declare, it's usually over.
and yes, and these green overlays, they're the declared ones, right? But look at the unemployment rate here. Goes up 27% off bottom, recession. Look at that. Recession. Look at that.
Yep.
Recession. 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 100% success rate. Recession. Look how much we've moved now off a bottom, 27%. And every time it's moved up 27 or 25%, it never fails to keep going up even more. Here it doubled. Here it doubled.
Interesting.
You see the recurring theme? It doubles here.
Mhm.
It doesn't stop there. It doubles or triples. Here it quadrupled. So when I see that, I'm thinking we're very close to being in a recession. It's like, and the yield curve.
If not the fact that we already are in a recession.
We could be. And silver dumping and gold dumping, it's signs that maybe we're in it. You know, it's like oil. This is very, I hope a lot of people will watch this because there's a lot of valuable information here. Check, oil is in, I'm not happy about oil. And this oil dumps. Look at oil in recessions. It goes up, then, recession, down. That's the flare up. This could be the flare up we're having right now in US stocks. Now that down, recession, like even the markets were pricing in the recession, even showcasing troubles like way ahead, right? Done. And now look at that, Danny. Goodness, you're not a TA guy. Well, you do TA sometimes, no?
Yeah, I've done TA before.
But look at this. This is not bullish if it breaks down. Like I've done your show. I was looking at bullish scenarios, but as an objective scientist, or whatever you want to put it, if that breaks down, this is a catastrophe waiting to happen. It's like if it breaks down, there either, maybe a false breakdown and then goes up.
Yeah, it's hugging that support line.
That thing here it has to hold there. And right now, we could be seeing the last flare up in US stocks, but then the commodities are telling you, hold on. The unemployment rate is telling you, hold on. The yield curve uninverting. Look at this yield curve thing there. Is it still going up? It's going down. Check this out. The yield curve uninverting. Look, on the way up. On the way up, recessions. On the way up, recessions. On the way up, recessions. It's like I could overlay that with the unemployment rate. It's practically the same chart. So you have this macro evidence that it's pushing hard to tell you, look, this flare up right now, you could play Bitcoin, you could play all these cryptos, but you got to be very, very nimble right now. It's not time to, let's say it starts correction on the daily chart and then the weekly. I'm going to wait until this resolves. I don't think that's the most. If it goes up and rockets and just explodes away from your entry point, that's the best. That's what you want in a blow off top type of melt up, right? Stuff that just like doesn't make sense anymore, right? And FOMO and how come I'm not in cryptos? But as soon as they start faltering, then you got to step aside there, right? So you just got to be really careful.
Hey guys, quick pause. I won't take too much of your time, but if you're looking to add into your gold and silver stack, please consider Miles Franklin. More specifically, email them, info@milesfranklin.com, and tell them that Capital Cosmos sent you in the subject line to unlock special pricing that you won't find on the website. In the unlikely event that you don't like the prices, you could always not buy. There's no commitment necessary, but I do recommend Miles Franklin for a number of reasons. The customer support is top notch, the prices are great, and I know the people there. Great people all around. So with all that said, let's get back to the video. Thanks, guys.
Bitcoin. So that's like from the macro. But you know what, guys? For the miners, look at this, guys. I have the ASA chart here at the bottom pane. This is the fuchsia line. What do you call that color? I'm colorblind. Pink, fuchsia.
You can just call it purple.
Purple. Oh,
Are you really colorblind?
Green, red. No, green, blue, and red, brown. So I could see them. I had tricks, but when I do the tests, like, when they put little dots and if you see a certain number, it's because you're like, I feel that all the time there.
I see. Wow.
Look, ASA loves, so the miners guys love these recessionary type of setups. These look at the miners, how it tracks the 7-year rate of change of the unemployment rate, right? So as the unemployment rate rockets upwards, if the miners had a chance to shine, it's now. It doesn't mean that they're going to get dragged down, maybe on a market turn on a CRE event a little bit, but right now it's their chance to shine. It's they love this stuff, right? Low energy costs, whatever. Oil, gold price is still pretty high, stuff like that. Whatever narrative you want to put for them to go up, but the chart's telling me that they have a good setup right here. And here's my.
So wait, what was the takeaway from the previous chart?
The gold and silver miners love recessions to instigate a bull run after, right? That's why I often say here, the bull run for commodities, for gold, silver, uranium, platinum, whatever, insert your favorite commodity, your miners. It's after the CRE event. Whatever they did now is just a setup. Once we have the CRE event, the gold breaking out versus PX with, okay, this is important, with, where are my tenants? I should pin that one. Where do I put my, here, this one. These are my tenants. Once this breaks out, guys, with, I'm going to put it here, gold dumping a little bit, but with the markets dumping even more, that's what instigates. And there's going to be a recession in there, and the yield curve keeps on inverting, and the unemployment rate keeps rocketing upwards, and the jobless openings, whatever, the job openings, they plummet, all that stuff. With that breakout here, with all these elements I just named, on the onset of that, as soon as you have a bullish looking miner that's breaking out, you have to trust it because it has a full weight of evidence behind it, right? So whatever catastrophe happens here on the turn, the shakiness of the US dollar going up, shaking the markets, like all that turn, once you're out of that turn, you could breathe now, because now you have the macro capital flows behind you, and it'll make your trade much easier. It's on these turns, Danny, that people get slaughtered because it's they over leverage too early. They try to front run the event before the event happens. It's not optimal, guys. You shouldn't do that. Just wait. You're so close to that type of turn.
So can't we use the Bitcoin price as a proxy for liquidity? And if that's the case, shouldn't we expect the stock market or the markets in general to continue rising on up?
Well, you're going to have to do, where's my target here? That's the correlation between Bitcoin and the markets over long periods of time, they track together over long periods since
Mm.
inception, since 2009. Leverage 3x and Nasdaq is almost the same chart as Bitcoin. But if you look in more details, Bitcoin most often tops before the US markets. But as soon as Bitcoin turns down, then you have chances of the markets having put in their tops. But you got to remember the markets are already way above Bitcoin, right? Bitcoin's around, it's starting now to move up, right?
Mm-hmm.
So is that the last flare up for Bitcoin? And after that, everything turns down. Remember that Nvidia chart, right? It's losing momentum now. So it could keep climbing up, but it's not climbing up as fast as it used to. So, and it's not at a low risk entry point. So you got to really like take all that into consideration. But you can't, it's hard to say this is a full-fledged new bull era for cryptos, for US stocks, for growth, because of all the other elements I enumerated before, right? You
Mm-hmm.
play this, like this is a gold, Bitcoin versus gold. It's a clean breakout. If gold stays around 2,600, if we reach that upper line here, ratio of 34-1, then Bitcoin should be worth, 88,000. That's another target, right? At that point, you have to revisit that. Uh, there's a whole bunch of other different techniques there, but goodness, it's already 84,000 Bitcoin. It's getting close.
Yeah, that's what I'm saying.
It's already close to that. I did that. It was, I think, sub 80,000 there, whatever. So it's fast, and it could flare up, Danny. Bitcoin could flare up now, and that could be it there. It doesn't mean it's a new bull era. It doesn't mean you're short either. It just that
So
unemployment rate.
Bitcoin is just playing catch up.
Well, or yeah, a final melt up, flare up. It's doing its thing. It's like it's outperforming practically all the other altcoins, all the other coins, except maybe Solana. It's on par. So it's like the only one really. There's probably two cryptos that are really doing what Bitcoin is doing right now, right? Like really outshining. So I don't know how it really works in crypto markets, but I'm pretty sure that in a healthy one, they all participate, even the crappy stuff. When the crappy stuff participates,
Yeah.
that's true liquidity, right? That's like my money, like the crypto accounts or YouTube accounts, everybody's like pumping their coins, whatever. But that unemployment rate, man, that keeps trending upwards. You got to really take that into consideration, because the true market bottoms are found when the unemployment rate is peak and unwinding. Those are the true bull eras, right? So when the unemployment rate's super high, people say the unemployment rate, it's the end of the US economy, it's a disaster, but then it unwinds slowly. The slope of people don't believe, and then the markets just keep grinding higher as that unwinds. But now we're the inverse, it's starting to move up. So you're way more at risk of having the markets top and starting to roll over. But again, people should not focus on the word top. They should focus, okay, there's no low risk entry here. Even if the markets do go up, there's no low risk entry. It's guaranteed. When do I know that the tides have turned and we're entering a bear market? Well, just look at the charts, guys, and you'll get all the answers there.
How how much longer until things pop off though? I mean, it seems like we've been saying this for a while now. I mean,
Well,
how much
and
runway do we still have
yes,
left?
I'll show you. It's very easy to see how, let's go to the SPX. So this is the best objective way to see it. Just look at that 12-month moving average. You gotta close below that 12-month moving average before even thinking that before you even start going to a bear market, right? I'm going to zoom out. I'm going to show you the 2008, the 2000, goodness gracious, SPX. Here, I'll show you the 2000 rollover. You see, it starts with losing a rising trend line, losing the 12. Here was a scare here in 1998, losing the 12-month moving average. Then you lose the 36-month. Then the momentum has topped out, right? The momentum's losing more and more support. It takes time. It could fall. People always expect the fast fall, it's
Right.
going to dump overnight. It doesn't have to be like, it could go like, grind sideways for a few months, go down, retest. And then if the
It took
retest
three
fails,
years to bottom out in 2000.
look at that, 99 to 2001 to roll over. And then after that, 2001 all the way as to 2002, 2003 to bottom. Here, it dumped fast. But if you want to know when,
But even in 2008, it still took around 2 years to get to the bottom.
Mm. But from the top or for like, okay, the
From the
breakdown was
top. Yeah.
here. Sure, from the top. But the top, we like, yeah, it's only in hindsight we know, right? Like, yeah, well, yeah, from 2007 to 2009, so over 2 years, October, March, yeah, 2.5 years from peak to bottom. But from when it broke down, where you would have been able to exit, because you cannot exit the top, you cannot, right? Because you just don't know. But you do know here that here you had a sell signal here. You had another sell signal maybe on the failed retest here. So at this point here, a lot of people should have been getting out in this red candle here. That was probably your last on this candle close here in June of 2008. If you were looking at TA, you should have bailed. So you could count that as, so for that to bottom, yeah, goodness, it went down 48%. It took 10 months. And then of course, you'll never enter the bottom, never, right? Because you don't know it's a bottom.
Mm-hmm.
You don't know, right? People say, "Oh, I got to no." You don't know the bottom is, right? You'd have to wait, until some the 12 month is recaptured, then a retest from above, etc. But during all that period, gold was outperforming, so you shouldn't have even been in the stocks, right? Even if they're bouncing off the bottom here, gold was still outperforming SPX until 2011 or 12, and it's only when the SPX broke out once again versus on its like after a huge pattern here, that's when really you had to get out of commodities and just that's a true bull era in stocks that started here in this area here. And then after that, that's an uptrend. Higher highs, higher lows, above the 3 year, the 12 months, it's like, but look how far it is. So okay, in time, how much time is that going to take? I'll draw you a little roadmap. So let's say today's the top. Let's say today's the top. What happens? It doesn't go like that. I see people draw that on Twitter. I go nuts. Stop it, guys. That's a low probability event. Stop it. You know who you are. I'm not going to name names there. But what's more logical is it's going to bounce on the 12 month. It's going to go up here. Then it might top a little bit here. Here it might try the 3 year. Oh, then then after that it's going to go there. Then maybe. But look at all this time it's taking there for just a top to happen, and then even to close below that 3 year moving average.
You basically just have to trust the process.
Yes, treasure process. Look at that. 2025. It could be next year and even 2026 before there's a full meltdown.
Mm-hmm.
It's like people always like it's crazy there. It could take time there. Yes.
You essentially know the displacement, but not the distance.
Yes. And the displacement is dynamic, right? It's because the moving average is inclining. And if the price keeps inclining, here you're stretched from the moving average. That's another thing to watch out for, right? Because now you're getting stretched. Remember that NVIDIA chart, that gold chart? So if ever that rising momentum trend line falters, this line here, then there's a high likelihood that we're entering a correction, right? Higher likelihood. So we're not even losing rising momentum here. Not yet there. Maybe here a little bit. But so step one, you got to lose that rising momentum and those rising trend lines. We're not there yet. And even if it starts faltering, you'll still have a lot of time to exit because think about it, like what the market's going to crash and everybody overnight is going to hit the sell button. Everybody, you're telling me there's no pensions or funds that had pre-programmed money to keep buying over the next year. The directors committee, they said, okay, we're authorizing 10 billion to be bought this year. That stuff's still going to go through, right? It's going to trickle in, right? So it's not, it's like Seinfeld said there when you want to break up with a girl there, it's like the fridge, right? You can't push it one time there. It wobbles the fridge until it falls over. So there's no panic. There's no need to panic. This is a monthly chart. The process, like you said, could take 3 months, 6 months. You'll have a chance to exit your longs on the retest of broken support. There's a whole bunch of, there's no reason to panic and say, oh, I have to get out now. It's the end, The only thing, my takeaway is the low risk entry is not there anymore. That's step one. If you're in already, well, the exit signal is not there either. It's just most of the time the market does not have any low risk entries. People have to accept that. Most of the time, the low risk entries are rare because you need a breakdown, you need a basing pattern, then you have an explosion, right?
So Warren Buffett had a saying that you should always reevaluate your portfolio. And if you're not willing to buy a stock today, then you should sell it, right? By definition.
No, that's wrong.
Okay, you don't think so?
Well, no, because sometimes it depends when you entered. If I entered at a low risk entry right there, and that's my position size, buying the risk was evaluated based on that price much lower when the momentum was squished and not stretched. That low risk environment happens at that moment at that price. That's the time to buy. As the price goes up, if you're stretched from that moving average, the risk to reward ratio is not the same anymore. The risk profile is not the same anymore. So even if I'm long that, it doesn't mean I keep adding on that thing. The profile is not the same anymore as it was at the bottom. I want to buy at that price. At that price, I don't want to buy it as much because now the chances of it
But why
goes
wouldn't
up.
you sell? Well, so you say you wouldn't sell because of the low risk entry point that you have.
I wouldn't enter. Well, I wouldn't add. I would just write it the way it is based on my trading parameters. So I would exit once, let's say I'm super stretched from the moving average. Even before it starts faltering, I might start exiting some of my longs, selling into strength. Very hard to do. It's instinctively people they can't do it because they're always afraid. What if the price goes up after? Like you don't when you're stretched from the moving average, it's always fine to take profits. Then you could sell into some weakness. So when the smaller time frames start losing the moving averages and or even the 12 period moving average starts faltering and closing below that, sure, take some off the table because once you've realized you're at the beginning of a correction, that correction could be the top, but not all corrections are tops. So you could just step aside. Oh, I'm in a correction. I'm stepping aside. If ever that correction resolves bullishly, I'll get back in. If it doesn't, hey man, I just avoided a huge bear market, right? Buffett, I don't want to put my philosophy on the Buffetts and people love quoting them and the guys, that guy manages, I don't know how many billions. He's not you guys. We're not him. Nobody of us is him. He has different parameters, he can't load and offload like I do. My whole portfolio in a liquid stock, I could dump it. I'm in out, practically no slippage because I'm not pushing around billions of dollars. He doesn't, don't throw away your advantage of being a speedboat. That guy is a Titanic. He's a huge boat. Why would you remove your advantage and play his game while you're super mobile? You could get in and out of these corrections without even blinking an eye. Man, it's like there's no reason for you to hodl and have these big mindsets and to try to rationalize why, because he's going to always try to find reasons not to sell or not. He's going to really wait until
he just sold. I mean, some of his most precious stocks.
Well, that must be,
he's what, $200-300 billion liquid now.
So for him to sell, there has to be a big reason. He's not going to sell because of headline news. For him, his models, his crunching, his head, his team, his plethora of analysts, they've done their research. And before he starts selling, he knows it's like for him, that's his exit strategy, right? He entered super low. He's exiting there. Doesn't mean the price can't keep going up, but he made his money. He's happy with his results. He's exiting, right? He's not. But us guys, we're so mobile. 95% of all us traders there, even investors, we're so agile. Goodness, we could go in and out there, and the fees are low. It's like it's crazy. Like I don't get it why people throw away that advantage just because they're afraid to look at their portfolio. They're afraid to just connect to their stocks, or they have too many stocks. That's another thing. People have 20, 30, 40 miners or whatever, and then it becomes technically hard to sell them. I have to go there. There's slippage here and I'm losing there. It's like you have to put yourself up where you have to have like an eject button. If you need to pull, if you need to hit it, it has to be easy. You can't be, you can't have these operation hurdles that you put yourselves, you got to be lean, fast, choose very highly liquid stocks. The chart's nice. You play it, you exit if ever, it starts entering correction mode. And keep it simple.
Okay. Well, I think we've covered pretty much everything. Anything else you want to talk about before we wrap up?
No, it's all good, Danny, man. Always happy to catch up. And I hope people find value in this. That's the most I could ask for.
Yeah. Yeah. And if you guys are interested to learn more of Patrick's work here, we got the link down to North Star Bat Charts down below. Be sure to click in and see what else Patrick and his partner have in store for you guys. Also, if you got value out of this, give us a like, comment down below, go Pat, go, and subscribe to the channel if you haven't already, so we can keep getting more guests like Patrick And check out our Substack, capitalcosm.substack.com, to support us there. And with all that said, thank you guys for watching. Thank you, Patrick, for coming on. I'll catch you next episode. Bye, y'all.